Hi, this is Todd with a video update. Today we're going to talk about focusing on the plan, not the portfolio. Given the current market volatility, I thought this would be an important topic so people can understand how we plan for volatility, recessions, and so forth. So typically there's three paths to retirement. Save more, invest better, retire later. And we have to modify these to meet or attempt to meet your lifestyle, projected lifestyle in retirement. If not, we end up reducing your lifestyle in retirement. So some of the things that I focus on as far as my job is I help clients make rational decisions about their money based on data. I'm a teacher. I help educate clients about institutional investing, factor investing. I'm a bouncer. I help keep bad things out of your portfolio. I'm a coach. I help clients avoid bad investing behaviors and stay on track for their long-term goals. This is really where planning comes into play. I also help clients focus on their optimal outcome, so aligning their money and their values. And we share best practices and help clients get stuff done. So when we think about planning for retirement, a lot of people are here and they want to end up here in 10, 15, 20 years, whatever the case may be, even longer. Even longer when you plan on living in retirement. So this retirement period could be 30 plus years. So you notice the plan and the planning process is a squiggly line. It's not a straight line. It's not a smooth curve. And it requires adjustments of plans. It's a dynamic process, and it requires adjustments along the way. But most clients want to know, am I okay? Can I live the life I want to live with the money I have or I'm projected to have at retirement? How do I create an optimal outcome? How do I align my money with my values and goals? So what we do as part of the planning process is we define reality. Where are we at today? What are your projections? What should you have based on your spending and savings and income and so forth? We focus on a plan. We take action. We avoid behavioral mistakes. We focus on the guiding principles of philosophy, strategy, and process. We have discipline. And overall, it's a dynamic approach because, again, these things change over time. So many people confuse risk and volatility. Risk is not volatility. Risk is really something much more long-term as far as outliving your capital, not achieving your lifestyle goals, permanent loss of capital, panic selling at lows during a recession. And most people's greatest fear about their finances is not having enough money to live comfortably in retirement. So the oldest and strongest emotion of mankind is fear. And the strongest kind of fear is the fear of the unknown. So what we try to do is quantify it in the planning process. Owning stocks is a long-term undertaking that doesn't just require patience. It also requires a high tolerance for pain and uncertainty. And many investors don't realize this. But the fact of the matter is, to get good 10-year rolling returns, we need to be invested in stocks for the long term, 10-year rolling periods, many 10-year rolling periods. Sounds obvious, but in times of crisis, it's very hard to do because of extreme pain. And sometimes this pain causes investors to make behavioral mistakes, overreact, and miss the eventual upside. So we just had elections here recently, and here's a quick market update regarding elections. Typically after elections, these are midterms, the markets are typically higher, 3 months, 6 months, and a year after the elections. We will see what happens, but we've had a lot of volatility here recently this year already. We're 10 years into the bull market, so I think managing risk is very important in understanding what risk looks like as far as daily fluctuations. We're going to go through some of that right now. So many people have seen this slide, but we just recently had our second 10% plus pullback in 2018. And although that's a little bit unusual, this was the 23rd correction since 2009. You can see many of the different pullbacks, percentages, and sort of the reasons for doing that. And keep in mind, you guys can pause any of these slides if you want to take a deeper look at any of the slides, and then just hit play again. But this is normal. This is what recessions or pullbacks look like, even in a bull market. And if we have a recession, it's probably going to be bigger numbers than what you see here on the page. In October, we had the largest global sell-off since 2008. So a lot of volatility just happened in October, and now we're partway through November, and it's come back a little bit. But this is perfectly normal. And you can see on a month-to-month basis, quarter-to-quarter basis, there's huge volatility. Even when you look at returns on a yearly basis. So these are drawdowns within a particular year from the high of that year. Okay, so 2017 was very low. We didn't even have a 3% pullback, so that's very unusual. In 2018, we've had two 10% pullbacks already, the largest being 11.8% here in October. But drawdowns are very normal. And the key is when we think about portfolios in our plan, we have to survive the short term to win in the long term. So since 1950, there were 38 times the market was down 10% in a given year, more than half the time. And 14 times, almost 21% of the time, it was down over 19%. So this is normal, and we have to plan for this, and we have to not be worried about it. Just know it's part of the process of getting long-term returns. Here's another way to look at that is even though we've had those drawdowns in a given year, here's the drawdowns. In most of the years, 32 out of 38 years, the market was positive. But again, we can have big recession, crises, drawdowns, and we have to plan for that as part of the process. And those can be painful. The last two recessions were each down 50% over that recession. Here's another example. Again, you guys can pause these slides if you want to look at the details, but these are bull and bear markets over the different periods. The average bull market was up almost 100%. The average bear market was down 28%. So when we think about returns, this is a slide I love, and people really need to understand what we're talking about here, but we don't have average returns in the stock market. During bull markets, they're up typically 16, 18% plus over those bull markets. And recessions are swift. They happen quickly. The risk happens quickly, and they are down dramatically. So they're down on an annualized basis, say 19 to 20, 30 plus percent. So bear markets are painful, twice the pain from losses. They unfold very rapidly. The last five bear markets were down 49%, 42%, 26%, 39%, and 25%. And the average recoveries were very long, 3 to 5 years to take and recover in the markets. So we want to avoid the behavioral mistakes. We want to make sure people have the right portfolio, and we want to make sure we plan for this in advance. And we do. So here at my firm, we use a software called Money Guide Pro. This is sort of what it looks like is we input a lot of your different variables as far as your current situation, how much you make, how much you have, your portfolios, and your lifestyle. We align that with the lifestyle you want in retirement. So we try to answer the questions of, am I okay? Can I live the life I want with the money I have? How confident are you can support your lifestyle over the next 20 to 40 years? Are you saving enough? When should you take Social Security? How long do you need to work? All these different variables to get us really what are the odds of success. And we put the spending into needs and wants, and wishes. And then once we get this in there, we align sort of your goals and values. We plan for different life transitions with kids in college and healthcare and many different things, all within the effort to basically have you have the best possible life with the money you have. And then we can stress test the portfolio in regards to recessions, low returns, living long time, big healthcare expenses, cuts to a pension. We can stress test the portfolio. So it's very powerful software. If you haven't done it, I think this is the best way to look at planning for future returns over 20, 30, 40 years, and savings and spending. So when we model the software, we can actually go in and we plan for recessions. So it runs 1,000 different iterations of a portfolio. You can see you have sometimes the portfolio is down 18%, maybe down 25%. Many years it's up, and we plan spending around these different areas. We can also model a worst scenario. So this is sort of an average scenario. This would be a worst scenario, and see how long the money lasts, what the odds are of success, and plan accordingly as a part of a dynamic process. And it really does need to be dynamic because, again, these are returns in the stock market from 1976 to 2018. A 60-40 portfolio returned about 10%. If we look at since the 09 lows through the end of October, a 60-40 portfolio returned about 11%, so slightly better than average. But if we look moving forward, we expect returns are going to be lower. They're either going to be low returns and sort of grind forward, or we could have a recession in the next couple of years. And because of that, recessions have lower returns. So our future expected returns for stocks are about 6%, bonds 3.5%, gives a 60-40 blended portfolio, a return of about 5%. So we have to dynamically manage spending. We have to understand how much to save, how long to work, and all these different variables in the software. We might not have low returns, but we plan for it because that way we're not prepared. If returns are better than what we expect, that's a good news scenario and people have more money and can do different things. Bonds are the most challenging because if you look from 1976 through the mid-June of 2018, bonds returned about 7.3%, just 100% bonds. Moving forward, we expect bonds to return around 3.5%. And actually, so far year to date, the aggregate bond market is down about 2.6, and it's the worst year since 1976. So it's rare for both stocks and bonds to be highly valued at the same time, but that means we're probably going to have some lower returns. So how do we plan for that? So when we construct portfolios, these areas for short-term bonds, intermediate-term bonds, are really designed to provide 3 to 5 years worth of spending in retirement, rebalancing opportunities, reduce risk. We plan on dynamically reducing spending in bear markets, and we use these buckets sort of for liability matching. These other buckets of alternatives and stocks are there for long-term growth, compounding, dollar cost averaging. So if we have bear markets, people are spending and withdrawing from here. We're using this for rebalancing. And in rebalancing, and if you're younger and still accumulating, when stocks are down, you're dollar cost averaging into cheaper stocks. So that helps out over time. So some of the things that we really focus on, again, just to summarize, is how do you get from here to the lifestyle and retirement and goals that you have in the future. It's not a clean-cut, one-time process. It's a dynamic process. But we want to find out if clients are okay, if they're on the right path, if you can live the life you want to live and have optimal outcomes. And we want to find this sooner rather than later. This is always easier to change this path if we have 10 or 15 or 20 years to change this path. If clients come to me very late in the process and they're, say, 60 and want to retire at 65 and they haven't had a plan and they don't know how much they need and they don't know what their lifestyle is going to be like in retirement, it is very hard in 5 years to change this plan and save enough and get to the outcomes that people want if they haven't saved enough. So think about this. Call me, use the link in the page to schedule something on my calendar if this is something you want to do. But I encourage everybody to focus on the plan and not the portfolio. Thanks for the time. Here's my contact information. To contact me, again, use the calendar link in the webpage. And thank you so much. Have a great week.